For the last 25 years, I've been in real estate, which is my passion. Back in 2015, I started working in the family office space directly for several prominent families on their real estate portfolios. With 70% of families losing their wealth by the second generation and 90% by the third generation, I then realized that real estate would be the missing component for families, allowing them to maintain their legacy and mitigate how much wealth is lost for future generations. It was shortly after working for my first single-family office that I started interviewing successful real estate families and industry experts. These conversations, combined with my first-hand experience of working for families on their real estate investments and currently investing on behalf of families, that has allowed me to share this knowledge with other family offices, family members, and family office professionals so they too can be good stewards of wealth. I'm DJ Van Keuren, and this is Family Office Real Estate Insights from the Family Office Real Estate Institute. So first off, I'd like to thank our guest, Peter Linneman, who's with us, many very well known in the area of real estate, prior faculty member at Wharton, and actually for 32 years, I believe.
Something like that. Still emeritus, but yeah, active for like 32, 33 years on the faculty.
And then found the Wharton's real estate department and the Zell Real Estate Center, and actually had the opportunity to work with Sam Zell for a while, which I'm sure there's many lessons that can be learned from Sam. Many people know who Sam is and whatnot. And so, our objective here is to really identify and provide valuable information for families when it comes to real estate investing. We do the largest family office real estate study in the world, and a lot of people created their wealth from real estate. And it's also the second greatest area of wealth creation after their initial area that they created their wealth. And then also, and Peter, I don't know if you're familiar with the statistic, but 70% of families lose their wealth by the second generation and 90% by the third generation. And I'm a huge believer, and that real estate can be that gap to help maintain that legacy and build that legacy over time as well. So one of the first questions I want to ask you is, you've gone through numerous cycles, right? And then we had COVID, which was sort of.
I think you just said I'm old.
No, well, been through one cycle.
Which is true. I'm 71, so you're right.
But that's not necessarily bad because you have all of this wisdom that you can share. So what is the biggest things that you've noticed or that you've learned when it comes to real estate investing through various cycles? A lot of people are worried that we're going into a recession, et cetera. So what are some of the I guess, when you look back to say, what to be aware of and then how to take advantage of those opportunities and look for there as well?
So a couple of lessons that really stuck with me as I've gone through, not just the down cycles, but the whole thing. And it's consistent with some research I've done, which is twofold: low leverage and long hold. And everybody likes the sexiness that comes on a spreadsheet with lots of leverage and short hold. And gee, I'm going to time it perfectly and all this kind of stuff. And the real result of my research and my observation is do it for the long term and do it with leverage where your coverage ratio is low enough that even if income falls by, say, 10% more than the historic largest drop you've had, you can still cover. Yes, you may have to defer a little CapEx to cover, but you never want to be in a situation where you lose it. And you invest in quality real estate. By quality, I don't mean you have to have the best. You have to have an asset people want to deal with. You can't be in the business of bribing them to deal with you. That doesn't mean you're not competitive, right? But if you're in the giveaway business, it's just too hard. So good things tend to happen to good assets, particularly when you have low enough leverage to let you survive the downs, and particularly if you hold long enough to let things even out, because the world rarely comes to an end. And you have to be able to survive those times when it looks like it's going to come to an end, because after that, things occur. And I'll stop by saying one of the things I've observed is in a decade, about 2 years are a lot worse than you could ever imagine. About 2 years are a lot better than you could ever imagine. And about 6 are around what you more or less think if you're good. You have to be able to survive the bad and enjoy the good. And you don't know quite when the good and the bad are going to occur.
So when you say low leverage, what if you had to put a percentage on that? What would you say? Would that be 60%, 70%?
Well, it differs. It differs. A property category like multifamily, a 10% drop in multifamily income is a big drop. It just is, statistically, historically. So obviously on an asset like multifamily, you can push the leverage up 65, 70% pretty comfortably, because you can still get good interest coverage even with that. You take property like office, if you lose a big tenant, you have a tenant taking a third of the building, whether it's your fault, they go bankrupt, there's a merger, they no longer want the space, whatever, you can get 30% drops in income pretty easily in property like office. So there you're going to want lower leverage, probably more like 40 to 55%. Now, obviously, if you've got the U.S. government as your tenant for 15 years in an office, but you could be much higher debt. So the real point is to think about it as a risk matter. How big could my income drop? And it's interesting because office incomes are more volatile as a sector than other sectors, just to stay with that. But warehouse can be also volatile if I've got 150,000 foot warehouse all leased to one tenant.
Yeah.
So it depends on not only the sector's volatility, but your tenancy and its volatility. And one of the nice things about multifamily is nobody's credit worthy, but taken together, they are, and they don't just disappear on one corporate decision.
Right. And that's, I was working for the Heyman family, who's also on your board, Robert Heyman, and they're from Georgia Beverly Hills. And we were doing office, and that was really my first time really focusing in on that space. And that's the biggest thing that I caught immediately was that if you lose one of these tenants, you're going to have a vacancy rate that dips pretty significantly. And you have
by the way, you could even, and I didn't mean to interrupt, but you could have it even if the overall market's vacancy doesn't dip. Right. It just, it's a 94% occupancy market, let's say. But if you happen to go from 90% down to 70 on one tenant, and it takes 2 years that's ugly.
Yeah. So we're going into the end of 2022 right now. A lot of people are worried with all the rise in interest rates, not sure what's going to happen. What are your thoughts today on office?
Office right now is a risk investment. I think it's a good risk investment, but it's absolutely a risk investment. And by that, I mean, I believe people get back to the office pretty much in full. It's taken longer than I thought in the US, been faster overseas. But it's a risk bet because even though I believe people come back to the office, my wife points out to me that from time to time I'm wrong. And, and if that happens, if people, let's say we stop at 55, 65% back to work permanently, that's a sector that's got to redefine itself. And so that risk doesn't exist with warehouse. That risk doesn't exist with apartments. That risk doesn't exist with even hotels, all of which have their own issues. But it's a risk bet. I think it's a good risk bet, but you need to bet that with low leverage. And I mean low leverage, because take what I just said. If it turns out that 65% is the most that ever comes back to the office, having a 30% drop in income is possible over a 5-year period or something like that. So I think it's a risk bet with very low leverage. I think the flip of that is apartments, which right now, there's no question overhanging multifamily, whether people are going to live inside buildings, right? And so there's a risk of overbuilding, there's a risk of a recession, means a few people double up with their parents for a while. But my research shows that basically things balance out, markets work. And so office is okay, but you have to understand you're making a risk bet. Again, unless you've got the US government or Microsoft or something like that on a long-term lease.
So let's talk, and it's funny, just to stay on office for one more minute, because, right after COVID, I heard we were talking about Sam Zell speak, and he said something that it made me smile. The younger generation, I'm sure, had no idea what he was talking about. But the question was, will people come back to office? And his comment was, I've never known anybody to manage by motive. Yeah. And I started laughing about that because I got it.
I believe he's right. And Sam and I have talked about this. We independently share the same view, but we would both say it's taking time and it's a risky sector. Look, it's a lumpy sector to start with, and then you add to it this bigger risk. It is an interesting risk play, but do it with low leverage.
So let's go back to the multifamily here for a second, because I was I used to sit on the board at Harvard with Rick Peyer's academic initiative, and we'd have conferences, and Arthur Siegel came in one time, and this was during the recession, and he stood up, and I'll never forget what he said. He just looked at everybody in the room, and he just said, buy at a high cap, sell at a low cap. And
there is something to that, although it's interesting. In the research I've done, with perfect hindsight and 10-year holds, just automatic 10-year holds, not terribly dissimilar to what Jeremy Siegel has done on stocks, where you just each quarter you buy and 10 years later you sell and you see how your total return was. The return over a 10-year hold is not terribly sensitive to whether you got in at the top or you get out at the bottom. If you get in at the top, and suppose you got in 2007, which with hindsight was a top, that's when Equity Office was sold. That's when Archstone was sold. That's when Hilton was originally. But I'll state, if you got in in 2007 into apartments, you pulled your hair out all of 2009, 10. Come back 2017, you did quite well. And by the way, I'll go the other direction. If you'd have gotten out in 2009, right, which was as bad as you could get as far as getting out, but that meant you got in 1999, and you really had some terrific income growth over basically 9 of those 10 years. So you had good cash flow, and your exit value was still notably higher than you got in at, even though you were going out at a low cap rate. So I'm not saying there's nothing, but if you hold, you minimize the getting in, getting out. If you're trying to do it on a 2-year or 3-year hold, it's all about, do you get in high? Do you get out? Do you get out high? But over longer periods, not so much.
So what I hear you saying, and I just did an analysis about a month ago or so ago, went back as far as I could with the REIT. When we started with the REIT index, compared that to, or actually the S&P compared to the REIT index over time, and the S&P, I think it was at an 8 or 9% historically from that time, where real estate was 12. So am I hearing you right when you say, as long as you hold it for 10 years, it really doesn't matter? So whether the market's up or down, as long as you hold for 10 years, that you're still going to end up in good shape?
It's interesting. I did REITs on 10-year holds, and I did NACREIFs. For those that don't know, it's an index made up. It's a non-investable index made up of investment grade properties that are owned by institutions, right? Mm-hmm. But you can't literally invest in NACREIF, but it's kind of a, what would you call it? A proxy for what you can invest in institutional. And I did it for both of them, and you never lost money on any 10-year hold. On any 10-year hold that I examined, you never lost money on any of the property sectors, unlevered. And if you went to modest leverage, you never lost money on any 10-year hold. The problem was that if you went to high leverage, you weren't around to gain from the later if you lost your property, right? So, but it was an interesting result. You never lost money. And I'm doing from the top of my head, on leverage, you were making like 9%, 9.5% on average. I think apartments was the highest, office was the lowest, but they were all basically 9% plus or minus 0.5%. And that's unlevered, and never lost money. Now that says get in. Now, when you by the way, as you know, if you took a 9% return and you levered it, 40, 50%, you're going to get 13% roughly. And it depends a little on. So are you going to, is that unbelievable, opportunistic, and so forth? No, but it's not bad as a stay rich. So one of my good friends is Darla Moore, and Darla and her now deceased husband had this phrase: you have get rich money and stay rich money. And that's kind of what I was referring to with office right now being a risk asset. It's more of a get rich investment. Most of real estate, particularly with modest leverage, is stay rich money. It's stay rich money. And you clip off 9 to maybe 14% returns over a decade. Not every year, right? But over the decade, that's what it's going to average out to. And you're going to pull your hair out a couple of those years, and you're going to think you're a genius a couple of those years. But that's what it seems to turn out. And it turns out that way because markets work. If something gets overbuilt and demand drops, supply shuts down. The economy recovers. It fills the space back up. It takes a couple of years. The space creation lags. You overshoot. You do better than you deserve. And then things balance out. And that is, I know it sounds trite. Markets work, or more or less work. And people forget that. And the other is the world doesn't come to an end. That's one of the reasons I think people come back to the office. We have witnessed very few paradigm changes in our lives. We've witnessed a lot of evolutions, but very few paradigm overnight changes. And this would be an overnight change.
First off, what you said about it's a stay rich type of investment is so big, and it goes back to what I spoke about at the beginning, where, so many families lose their wealth, and real estate can help maintain that.
Absolutely.
Which is huge, so.
By the way, I'll say one other thing. Yeah, a screwdriver is a terrific tool, but if you try to use it like a hammer, it's not going to generally work.
Yeah.
If you largely have an asset that is basically a stay rich asset, and you try to make it a get rich asset, doesn't mean it can't work, but you're not using it to its maximum advantage. You can use a screwdriver to drive in a nail, I suppose, by using the handle, but it's not optimal.
No. So what about one of the things that I've experienced that families love the aspect of investing into a property, refinancing out what they invest in, and then letting it go.
Right.
So are you an advocate then of that strategy where you go through
basically
over time,
yes,
taking out money?
Basically yes. I mean, you can always find an exception and so forth, particularly with development or redevelopment. That's one of the ways to move up the cash flows by refinancing out as you add value. So yeah, I mean, it's a proven, put it this way, it's a proven strategy.
Right.
And that's not to say there aren't other ways to make money in real estate. That's probably the best, single usage. And the only thing I'd throw in is whenever the tax law was passed, 3 years ago, 4 years ago, they put this opportunity zone legislation.
Just going to bring that up. Yeah.
Well, and the only thing I point out, and it's technical, but it's not that difficult, is you can generate, by doing real estate development with good partners, you can generate an extra 400 to 500 basis points IRR return because there's no capital gains tax, but you're on a depreciating asset. So think about that. No capital gain tax and a depreciating asset. And you say, well, there has to be a negative. And the negative is that you have to hold it for at least 10 years. And a lot of investors are understandably reluctant to commit for 10 years. And the other negative is it has to be a development or a very significant redevelopment. And some investors don't like to take on development risk. But putting that aside,
doesn't that go against what we've been talking about holding for a long time?
And one of the reasons I have an opportunity zone investment vehicle, not to promote it, but if you have questions, contact us. We can get you up to speed on what all the law is. One of the reasons I love it is it fits. You can't sell for 10 years. Mm-hmm. So in an odd way, and imagine you're my investor and you've decided to invest with me. And 3 years in, things aren't going so well because remember, 2 years is going to be worse than you ever dreamed, 2 years better, 6 about right. And, you say, oh, let's sell it because it's really going well. Oh, let's sell it because it's really going awful. And I have to go, we have to hold this for 10 years at least. And you go, oh yeah, that is the document I signed and it is the law. So I like the fact that you have the time to do the right things with the property. Whereas if you hired me for an asset and you said you have 3 years, I'll do my best, but I may not do all the things I could to really make that asset hum. Because I want to undertake the redevelopment and then sell it halfway through. That makes no sense. And so you do a lot more cosmetic work, a lot less substantial work.
Mhm. You know, it's interesting because since through our studies, the number of families investing in the OZ zones haven't gone beyond, I think, 34%. Now, some of that had to do because they weren't sure on the rules, right? And they were still
Right.
trying to get them in place.
Correct.
And then the second thing is really what you had said about, look, if you want to get up to date and understand how this works, unfortunately, a lot of families just still don't understand how it works. And so it's, you know, simply a lack of education, but
Right.
it's very interesting for what you're saying and makes sense on a long-term perspective. Now, here's one of my questions, and I could go on forever, but we've got limited amount of time. But and I love your thoughts on this, but you know, one of the benefits of real estate is it's not liquid. You can't sell it, right?
Right.
And so you can hold it for a long time. But what's happening, or what's going to be happening, is this the tokenization of real estate, which is going to provide liquidity, and how that may affect some people's investments and the market.
So I've been a big believer in REITs, which is a securitization of especially the public REITs, where you may not like the price, but you have guaranteed liquidity. The private REITs give you liquidity when you need it least, and don't tend to give it to you. And I'm not just talking about the current Blackstone. This is their history. They tend to give you liquidity when you don't need it, and have a challenge when you do want it. The tokenization, the other kind of fragmentation, I get it intellectually. It's not like I don't get it intellectually. I just think it's a hard push. And yes, I know, you know, there are vehicles. They do raise money. That people are trying to, but I've probably seen 6 or 7 efforts to securitize a particular asset, you know, a $100 million building or a $42 million building, or I haven't seen any of them really succeed yet. So when I say I'm a skeptic, it's less intellectual than I know some smart guys who have tried, right? And until I see it work, it's hard. I know buying a building privately works. I know buying it publicly works. It's just that it's a challenge.
Well, I think it's the younger gen, you know, with technology and stuff, that'll probably pick this up greater. But when first crowdfunding came out, I think 15 years ago, I was working with a developer and we tried to crowdfund. We had like 5 million of commitments and we only brought in $10,000, right? And now
and they've come
people are doing tens of millions of dollars.
Right. They've
and
come a tremendous distance. They've come and they're becoming a serious capital raise source, for lack of a better. On the other hand, if you take the amount of capital they're raising, it's small compared to the big scheme. But everything is everybody's welcome to the party, you know.
Right.
The more people come to the party, the more liquid everything is.
So a couple last questions. You know, you worked with Sam Zell. You still sit on a board with him right now. He's people that understand real estate or know real estate. I mean, he's considered one of the leading real estate people, right? That's been out there and known. Have you noticed, and you've known him for a long time, is there anything that you could identify that created his success, whether it's his philosophy or how he went about it or anything like that?
So Sam rightly deserves his reputation. And yes, there are some things I've taken away from him and others that I've observed. One is Sam's a long-term holder. People have this impression, I don't even know where they get it. that he's a flipper. He's not a flipper. If you look at him, he's a long-term holder of almost everything notable he invests in, right? He's not a flipper at all. He's a big believer in giving time. The second is he generally uses low leverage. Now, when before I knew Sam, in the 70s, when he was a young guy and had no money, of course he used leverage.
Mm-hmm.
But as one of the things that I think differentiates Sam is he realizes for everything there's a season. I think that's from Ecclesiastics. Mm-hmm. And so, yes, when you had nothing to lose, maybe using a lot of leverage made sense. But when you have something to lose, it's not the season for lots of debt. It's the season for lower debt and use the asset for what it's worth. And I think Sam has brilliantly realized those two things. The third thing I think that really differentiates Sam and a group of others, it's not that Sam is any better than most good professionals at figuring out the upside. I think he's a bit better at figuring out the downside. Mm. And by the way, he, like everybody, has had not successes, right? But he's better than most at understanding the downside. And that's a skill. It's a mental approach to things. Sam was trained as a lawyer. And we talked a couple of times about the difference between a law school training, which Sam had, and a business or an economic training. MBAs are taught primarily about all the things that can go right. And if you think about it, deals and developments live on the optimism of what could go right in an economy like the US, which is, going to grow 7 out of every 8 years, and the down's not going to put you back that far. That's a good position. But avoiding big downs, because big downs, you have to make up for lost ground, right? Think about if you could run, nobody that I know of has done this. Imagine you ran a hedge fund that never lost money on any trade, but they didn't make spectacular money on their ups. They'd have good performance because they don't have to make up for the downs.
Right.
And I think Sam is just really focused on the down, probably more than most of the people I've known. And I've dealt with, as you know, lots and lots of, and I wish I was as good as he is on the down.
Well, you bring up something interesting, and I've said that or realized this over the last couple of years, is that instead of getting a business degree, if I could go back, I get a law degree, because it seems like there is a lot of benefits, for having that. But so just to finish up, we've got a lot of families that may not have created their wealth or building another portfolio. What words of advice, other than the great ones you've already provided, would you tell somebody, that's expanding their portfolio of real estate?
I would not just limit it to real estate. If you don't understand it, you're not that dumb. You're probably right. It doesn't make sense. Okay. And I suppose you can find somebody dumb enough, but how many times in your life have you heard, I'll take one that's in the news, crypto. And I've tried as I might for the last 4 years. I've read about, I understand blockchain. Blockchain is a technology. It's not an exchange. It's just technology. I keep looking at crypto and I can't figure out what gap it's filling. At best, and by the way, I've had all these people try to explain it to me. And I'm not that dumb. I may be dumb, but I'm not that dumb. if after looking at it and having people try endlessly to explain it, I don't understand it, it's probably because it's not worth understanding. And I would, beyond the stuff I'd already said, I would say, if somebody's pitching you on a piece of real estate or a real estate deal, or we're going to do this or that, and you don't understand it, after really trying, I don't mean on a 30-second, you're not that dumb, and you don't need that upside. You're already well off. You don't need the upside. Stay rich. Stay rich.
Well, I'll tell you that's the primary reason that the Family Office Real Estate Institute came about, is because you have these families that's their whole life they were working in one industry, and maybe they made their money in chemicals, or they made it in tires, and they made it in tech. They all of a sudden have all of this money. They don't understand private equity, real estate, hedge funds, and then you have smaller components, right? Like healthcare VC, and then certain size healthcare VC. So it's not uncommon to not understand certain things, especially from a family office perspective. But fortunately, real estate, I think, is one of the easier type of investments.
I agree.
Understand.
I agree, but I'll take WeWorks in its original. I'm not picking. I'm just taking one. They're trying to become, with Sandeep, a real company and so forth. But the original stuff, I heard Adam speak. I read about it. I had been in the office sector for a long time. We had shared tenancy for a long time. We had sublease operators for a long time. I knew exactly what happened during the downturn. I just never got it. I didn't get it was a tech company. I never to this day understood how, because it wasn't a tech company. And so that was one. I'm not that dumb. I may not be smart, but I'm not that dumb that if you tell me subleasing space is technology, the sublease business. It's not. So that's a good example of what I mean. I'm not trying to pick on them, which is, if you're not that dumb, and don't be ashamed of not understanding it, because at least in Sam and I have kidded over the years, because you can imagine how often he gets pitched on stuff. You get pitched, he gets pitched endlessly, right? And usually the phrase "you don't understand" means you understand.
Right. Well, listen, Peter, thank you so much. There's so many other topics I could go into, maybe at a later date. We're very appreciative for your support and being on the board of the Family Office Real Estate Institute. And, one of the things that I do want to stress is that what you're doing at Liniman Associates is pretty fantastic. And people need to take a look at that, because, there's textbooks that you have, there's an educational video series, there's the Liniman letter, which is very valuable. And, we'll give people, let them know where they can find some of this information. But thank you so much. We'd love to have you back at some time, and we look forward to seeing you, hopefully face to face here in the near future.
My pleasure. You have a great day. Thank you, everyone.
All right.